Call it an east-west oil showdown for market share. The world's three biggest players, Saudi Arabia, Russia, and the U.S., producing nearly a third of global supplies. In November 2014, at this OPEC meeting, the kingdom doubled down the stakes as prices were spiraling lower.
They had to devise a strategy on the fly, and the strategy they went for was to keep production quite high, and even this year to increase production and accept lower prices and hope it would drive out the competition. And I think that's what they have to do, but they have to stick the course.
And OPEC has not let up, producing near a three-year high of just under 32 million barrels a day, adding to a daily oversupply of 3 million barrels, a 17-year peak. A third of the 12 OPEC producers are based right here in the Gulf, and they voted as a bloc to support Saudi Arabia in this fight for market share. Regional sources tell me they're expecting prices to be at $60 or above at this stage, planning for many of the U.S. shale producers to already be out of business. The number of active U.S. oil rigs has fallen like a rock by more than half in a year, but not American production as companies squeeze costs. Chris Faulkner, a Texas fracker, was recently in Dubai.
We're paying less to drill. We're paying less to frack. Certainly not 60% less, but that margin has helped us. So while we're doing things more efficiently on our side, we're also getting discounts from the service providers to keep on fracking.
The price advantage clearly sits in the Gulf producers' camp, where their cost hovers around $5 a barrel onshore. The problem in Saudi Arabia is prolific spending, especially by a new king who has opened up the coffers to maintain domestic stability, while fighting a war at its southern border in Yemen.
If we look at Saudi Arabia's budget break-even oil price, it was around $100 a barrel. So there's an absolute need to pull back on spending, especially with the weak outlook for oil in the medium term.
If history is any gauge, this price war could take longer than most expect. Saudi Arabia took a similar strategy nearly 3 decades ago, which was the last severe U.S. oil bust.
In 1986 they did the same, but it took almost 15 years for them to rebalance the market and drive out the high-cost producers. Now maybe it won't take as long this time, but it still might take several years, and they have to be ready for that.
OPEC players from Algeria to Venezuela certainly are not ready, but the Gulf producers have over $2.5 trillion in the bank and are being forced to use it. John Defterius, CNN, Abu Dhabi.